You know, the thing about beauty's in the eye of the beholder, and when it gets into our world, it really does become valuation is in the eye of the beholder. And one of the stories that we typically tell a client when we first get on the leading edge of a process, and maybe Gary will remember this, but somebody says, well, what's my business going to be worth when we go through this? And we typically say, we don't know. And you know, you hear things about what's a privately held business worth, and you know, somebody will first say 4 to 6 times EBITDA, and just think that that's a rule of thumb. But it's actually that beholder is where he settles on that spectrum is he's using the techniques that Randall just went through, whether it seems apparent or not. But they are going in there and looking at income, they're looking at asset value and those kind of things. And I guess the poster child for, you know, real world experience in that is a deal we did several years ago, and this is public information, for a barge company in Memphis called Waxler Transportation. And when we first got engaged, it was a third generation family, and when we came in to talk to Mr. Waxler, the patriarch, he kind of said, well, my boys think that we need to have an investment banker involved, but I don't really think so, but I guess we'll go ahead with you. And he said, but I know who's going to buy my company. I said, really? Well, who's going to buy your company? And he said, well, ABC Marine. And I said, how do you know that, Mr. Waxler? And he said, because for the last 15 years, every Thursday night at the Waterways Convention, you know, Billy Bob corners me and says, Billy, if you want to sell your company, you give me a call and I'll buy it from you. So he said, he's going to buy my company. And I said, well, no, he's not. And he said, how do you know that? Because it never works that way. So we went through this whole process and went out to a variety of large buyers, including people like Marathon Oil. And by the way, this company that he was talking about was over $1 billion company, so they know what they were doing. But when the bids came out, this entity he was talking about came in with about a $16 million bid, and we eventually sold the company to Secor, it's a publicly traded company, for $33 million. So it's not that the guy who put in the $16 million bid didn't know what he was doing. They were smart guys. It's just he valued it. It was in the eyes of the beholder for what that valuation wound up being. So what I'd like to go through today is to kind of give you some background so that you as a business owner or you advising your clients, think about these factors that are going to come into your eventual value when we typically get called in, and that's usually at an inflection point, usually related to financing or some kind of transaction. So, how did I do this?
The one on the right.
One on the right?
Yeah, the little right thing.
On the circle that just goes.
Oh, there you go.
There you go.
Okay, so when we get pulled in the process, what impacts typically the ultimate value is going to be what's going on in economic and M&A activity, industry dynamics, and company-specific risk. So think about things whenever you really hit this inflection point and you're going to go to quote market. You know, you should always be thinking about what's going on right now. And if you think about what's going on in the market right now, you know, you got the baby boomer numbers that are out there that everybody's seen. This is an interesting stat that we saw recently is over the next 5 years, 40% of family-owned U.S. businesses will experience a leadership shift. That's a lot of transactions happening. But the other thing that you might consider as a business owner or advising your clients is this down at the bottom, is that because of the demographics, there's a possibility that the market could be saturated by 2017 or 2018. And then again, timing being everything, you can see what's going on. And as Randall said, you can't really read these numbers, but if you look at, so in 2007, let me see, right here, 2007, you had $473 billion worth of transactions done right here at the top, and that was 1,500 transactions. 2009, that went down to 81 billion and 760 transactions. And now here we are in 2013, with these are halves of the year, so 6-month periods. We're at 140 billion and 738 transactions. Although this is skewed a little bit because you had about a $23 billion Heinz transaction in there. So it hadn't really, it's kind of coming back, but we still certainly would have a long way to go to get back to the glory days. And if you see what really took it down into this land right here, a lot of it had to do with the credit markets, and then of course just companies being hurt economically through the recession and the uncertainty. This is kind of where we are for the first half, getting a little closer, and you can see what's going on valuation wise through here, kind of in the 6 range across these years. We saw a little bit of a spike in because a quality premium came in here. There weren't as many deals, but the deals that were getting done were very high quality and people were paying up for them. So when you think about what's going to drive value when the company does go to market, again, it's a supply and demand type thing really at the end of the day. And in 2013, M&A is certainly a high priority. The strategic buyers, we're seeing more and more operating companies out there hiring corporate development staff to come out and say, your mandate is to go make acquisitions because some of the organic growth opportunities just aren't there. The private equity stuff, if you're the private equity firms, there's about $328 billion that's out there that's got to get put to work. And an interesting thing there is a lot of this money was raised back in 2008 before the wheels came off, and they really didn't have a chance to get it put to work. And if you understand the dynamics of a private equity firm, they usually get paid based upon assets under management, assets that they gathered on the front end of the fund, and about halfway through the fund, it flips to getting paid, say, 2% on what they've actually invested in. So these guys are sitting there going, you know, I got a $500 million fund, I've only got half of it invested. If I don't get it, the rest of it invested, I'm going to lose my management fee. So that's going on. Those kind of dynamics are happening right now. And then, believe it or not, fundraising's out there. Every day we get subscribed to a number of services, but capital raises hit the highest level in 4 years. A lot of funds are out there doing their second and third and fourth fund. So that's another great thing, or another consideration when you're thinking about what's going to drive value. Let's see. The types of buyers will also drive value. When we do a process, we've done one recently where, you know, it's not all processes lend themselves to financial buyers or strategic buyers, but sometimes there'll be a mix there. A strategic buyer is obviously somebody who's already in the business, they're making widgets, and they see an operating company that they'd like to bring inside their company, either because they're also making widgets or it's related to making widgets. A financial buyer, a financial buyer can look at things a little differently because they don't really operate a company. They don't have an investment in that industry, but they decided they wanted to get in the widget business. And in that case, they're typically going to come in and buy 70–80% of the company, and they're investing in the management team. A strategic buyer may or may not be investing in the management team. And again, their perspectives can determine how they're going to look at value. Where we like to focus a lot of times is in this hybrid area, which is where it's and this is a situation we went through with Gary's company, where you've got a strategic company, but it's backed by private equity. And in that case, what we like about that is that the private equity guys typically drive the process, and they understand how to make an acquisition, they understand timing, and usually it goes a little bit more smoothly than just a straight strategic. But again, that factors into the different perspectives for value. And let's see. If you look at the industries that are the broad industry things we see, what do people look for? Growth opportunities, whether the industry's fragmented or consolidated. And we always hear buyers say, I really don't want something that's just ultra cyclical. We hear people saying, what's going to drive value for a company? What are the risk factors relating to the raw materials, political uncertainty, and again, cyclical for as well. Let's see. So that's kind of on the broad industry, what's going on in the industry you're operating in, and then you start to drill down into the company dynamics. What are some things that people either want to pay up for, or maybe so-called do a ding for value? Obviously, everybody wants a highly profitable company. That's kind of easy to figure out. Customer relationships is a very interesting comment. We've dealt with companies where, okay, we just got a couple of big box customers in. Well, then the question becomes, well, really, how long have you had it? Because that's a two-edged sword. If it's a big part of your business and then they decide to go away after only being with you for 1 year, that's a big ding to value. So if you've been able to stick with your customers for a long time and can show that either through contracts or just customer relationships, you're going to have a lot higher value. Barriers to entry, either through trade knowledge or through actual intellectual property, is an important thing. And then management is obviously continuity, management turnover, those type things are very important. Risk factors, we've been pulled into a number of companies who said, look, I'm not ready to sell yet, but if I was, can you kind of tell me how ugly my baby is? And so we've come in and spent about 2.5 months going in and really trying to say these are some things that are really risk factors for your valuation. And a lot of it is in the financial reporting area. Some people don't do, don't have any kind of audit, compilation, or even reviews, and that's the first thing that we get asked from a potential buyer is what do you have? Do you have an audit or not? And then that gets into things relating to whether or not they're taking count of their inventories properly, or doing GAAP accounting, and it's just kind of that's passing the smell test. Customer concentration, again, back to my example about the big box situation. If they feel like that customer could go away and all of a sudden 30% of your EBITDA evaporates, we try to point that out. Now, typically, there's not a lot you can do about that, but you need to at least understand it. We did have one client a couple of years ago that was in the medical device business, and they had about Chris, what was that, the JKB guys? No, JKB. They had about a 70%. And we were going to take them to market, and they called us about 2 months into the process and said that their largest customer had said they weren't going to buy anything for the rest of the year. So we basically shelved the project, but worked with them over the next 18 months, and they were able to actually reconstitute their whole customer base, where I think the largest customer, when we took it to market, was only about 20%. And they wound up getting a good valuation. Management succession plan, again, people want to know, we see owner entrepreneurs all the time who are the face of the business, and that's a great story for everybody about you built it from scratch. But if it's perceived that you as the owner operator, if you walk out the door, that the business walks out the door with you, that's not good from a value standpoint. So we tell people, try to position your company where, yeah, it's clear that you're in charge and you're the business driver, but have a team underneath you, because if the old get hit by a bus routine happens, it's perceived as a value ding, and that works its way into the capital asset pricing model that Randall was talking about. Another issue that we run into driving value are contracts. We'll be three months into a process, and somebody licenses a technology for manufacturing from somebody. And we say, okay, can we see the contract? Because if you're going to sell it, you got to be able to sign the contract. And in a lot of cases, there's no assignability provision. So what do you have to do? You have to stop the process, go to the person who holds the license, and ask them if they will add an assignability clause. Now, if you're the attorney for the person holding the license, you probably say, well, yeah, we'll modify it, but what are we getting in return? And so, again, if you're a business owner, you're advising a business, these contractual issues are very important, particularly as contract assignability goes, because it'll hold up a deal. And as we all know, time is an enemy of getting a deal done. We've also seen right of first refusals. If anybody's ever given a right of first refusal to somebody, please try to get that unwound if you think you're going to hit an inflection point in a transaction. Intellectual property, we talked a little bit about that. Environmental issues. If you haven't been through a transaction, you've operated your business for 30 years and haven't had to have an environmental, a phase one done, that's something that is going to have to happen if you're going to change any kind of control of your business. But a lot of times, again, that hadn't been done, and that's a little bit of a interesting situation, because obviously if you find that you got a problem, you got to get it taken care of. We kind of just put this slide up here to talk a little bit about what we see, or when we go out to say 50 private equity groups and say, are you interested in bidding, or what are the issues with the transaction? And again, I've talked through some of these things, but customer concentration, when you've got a company that's got more than 20% with one customer, that's usually a ding. Product concentration as well. If you're making one product in one industry, that's perceived as a risk. If your product mix is going up and down, you don't know exactly, if you got a variety of products, but one's up one year and one's down the other year, and it's hard for the buyer to get an understanding of exactly what's going on. And the one we hear a lot of times is, particularly on the retail side, is Walmart and Walmart and Walmart. It's amazing the number of times, everybody always thinks that once you get Walmart, that you really made it as a company. It's amazing the number of times we hear from a buyer that I don't know about Walmart. So if you can manage through with Walmart, that's good, but recognize that there is a two-edged sword that relates to it. Another thing that comes up is C Corp structure. It's amazing the number of companies that we're dealing with. Again, they've been around for 25 years or so, and we're going to go to market and we find out it's a C Corp. And obviously you get into double taxation issues on that. And then the question is, well, what do we do? And then if you try to do the conversion, we get different reactions from people about whether or not go ahead and do it. I think we even worked with Randall on a couple of situations where, well, you can go ahead and do it, you can get challenged, so obviously maybe you can speak to that, but the more distance you can put between a transaction, obviously the better you're going to be. So, kind of as a close, I'd say the preparation really enhances value, and we really have suggested to people, that, again, to a lot of deal attorneys we deal with, if you've got a client that's thinking that they may want to sell in 2 months or 2 years, the preparation phase is really important. We would tell anybody, try to do it not when you're in the middle of a process. When you start hitting these bumps in the road during a process, all it does is derail it, makes buyers get impatient, they go on to other types of things that they may be looking at. So we really think that makes a lot of sense. I actually had a presentation to the Estate Planning Council a couple of years ago, and I've kind of poked fun at some of my friends there, because I said, as estate attorneys, a lot of times, you do a great job out there making sure that your clients got, trust for their children and other types of tax planning preparations. But, I say, how much time do you actually spend making sure that their biggest asset, which is their business, is in really good shape? And so we really do think that if people will spend some time, particularly if you've got 2 years or so to go get these things taken care of, you don't have to do it in the heat of battle. I'll say just one other case, and I think Gary's going to talk a little bit about. This is a deal that we did recently back in June, just to kind of do the spectrum. Sometimes, the market determining what really goes on. I think the recent Nobel Prize for Economics was given to the guys out of Chicago, saying that the markets that have always proclaimed market efficiency, and it all depends upon which markets you're able to go to. A lot of times when we go out on a deal, we'll go out to 50 or 60 groups that could be a combination of strategic and financial buyers, but sometimes that's just not available. And here's a case where a company made rotationally molded fuel tanks selling into the marine industry. Been around for years, 71-year-old owner, no apparent successor, no really great management team there. In that case, we just knew that there wasn't going to be a financial buyer for it. And we couldn't, and he needed to do something immediately, didn't have time to address those issues. So we basically went out to a small group of strategic buyers, and at the end of the day, was able to find a large company, about $400 million, who wanted to buy this company, who, interesting enough, had less than $10 million in revenues, but the but fit nicely into the portfolio. And again, it was a private equity-backed company that kind of had a hole in their offerings. So not all deals wind up being done to shop to 60 or 70 different entities. Sometimes you got to decide which market you're going after, but at the end of the day, want to make sure that the deal's been priced efficiently.